All right, let's see if we can knock out chapter three. Through chapter two, you really, without me even telling you before, you've completed the first four steps of the accounting cycle. You've identified transactions and analyzed them. You've journalized them. You've posted them to the general ledger, and then you created your first proof report called the trial balance. Well, in this lesson, we're going to talk about adjusting accounts for financial statements. And really, the first question is why in the world would we need to adjust anything? And it's because of that one time period assumption. If you remember back in chapter one, we talked about the generally accepted accounting principles. And one of the assumptions in there was the time assumption, and that is that accounting can be broken into periods or intervals, and that's what we're kind of showing here. That assumption says that we can do accounting on a yearly basis, a monthly basis, maybe a quarterly basis, semi-annually basis. There are a lot of different ways that we can break it up. Most organizations really look at their financials on an annual basis overall, but for management purposes, they typically break it into monthly pieces or quarterly pieces. And it's because of this time period assumption that we have to do adjustments to our financial accounts in order to make the time periods appear correct and to make them correct, not just appear correct, but to make them correct. And really, it all kind of comes back to some of those principles, which really give us the accrual basis of accounting. And that's the revenue recognition principle and that expense recognition principle, or the matching principle, as we discussed it. If you remember those four blocks we had on that one page. The accrual basis simply says that revenues are recognized when earned and expenses are recognized when incurred. And that is revenue recognition and the matching principle overall. That's what accrual basis tells us. We typically, as individual people, live on the cash basis of accounting. When you think about this, you typically say you have income when money comes into your checking account. That's when you think you have increased your income, when you actually put that money in the account or you put cash in your pocket. That's the cash basis of accounting. You're recognizing revenue when you get the money, and you also recognize expenses when you spend the money. That's called the cash basis of accounting. Accrual really falls under that GAAP method, saying that even if my customer hasn't paid me, if I've earned the money, I have to recognize revenue. That's accrual. And even if I haven't spent the money, I have to recognize expenses when I incur them, and necessarily in the period in which I incur them. If I were to go back and talk to you about that rent example, I prepaid my rent in January. I stroked a $12,000 check, but I really haven't incurred that whole $12,000 expense in January because I need rent every month. So really it's $1,000 a month. Therefore, I should recognize 1,000 a month. That's accrual accounting. Understand that cash is not generally accepted accounting principle. Do organizations and accountants use it? Yes, because it is a departure from GAAP, but in some instances it's okay to use it. And I will tell you that in real world accounting, programs like QuickBooks and even older programs like Peachtree, what's now called Sage or Mass, actually will give you the ability to switch your reports between accrual and cash. It really is a logical switch that can happen inside the computer that just converts the reports from accrual to the cash basis of accounting. So again, talking just a little bit more about this accrual basis versus cash. Here's an example. On December 1, Fast Forward pays $2,400 cash for a 24-month business insurance policy. Okay, it's the same kind of example as my rent, right? Using the cash basis, the entire $2,400 would be recognized as an insurance expense in 2015. When it was paid on December 1st, 2015, you're going to see the whole $2,400 hit in the year of 2015. No insurance expense from the policy would be recognized in 2016 or 2017, which is really the periods that are covered by the policy. So that's why it's a departure from GAAP, because GAAP says that you should be showing insurance expense at $100 per month, not $2,400 in December of 2015. On the accrual basis, here it tells us, on the accrual basis, 100 of insurance is recognized in 2015 for that 1 month of December, a whole 12 months worth, or $1,200 in 2016, and then the remaining 11 months in 2017 at 100 a month is 1,100. So you're really matching the expenses to the periods benefited by that insurance coverage, and that's that tricky part of the matching principle or the expense recognition principle. Again, recognizing revenues, revenue recognition principle states we recognize revenue when the product or service is delivered to our customer, meaning we've earned it. And then expenses, the tough one, it's the matching principle, aims to record expenses in the same accounting period as the revenues that are earned as a result of those expenses. It takes money to make money, folks, right? This matching of expenses with revenue benefits is a major part of the adjusting process, and that's absolutely true, and that's what we're going to look at here in Chapter 3. So let's talk about some of these types of adjusting entries. First, here's the framework for adjustments. It really is made usually at the end of the accounting period. It can be made any time in the accounting period. Sometimes you go into a period and you already know about it, right? So if you paid $2,400 for insurance back in December of 2015, well, you know you're going to expense $100 every month for the next the additional 11 months. So can you do that adjustment on the 1st of the month or the 5th of the month or the 10th of the month? Sure. But I will tell you from a consistency standpoint, and to always know where to go find the adjustments, we typically post them on the last day of each accounting period, or the last day of the month. So here are the types of adjustments that we can have if you're looking down here at this graphic. So adjustments. So it says paid or received cash before expense or revenue is recognized. Isn't that confusing the way they do that? Take out the items in parentheses first, and let's read that again. I paid cash before the expense is recognized. That's the insurance piece, right? I paid $2,400 in December 2015, but it should be recognized over a full 12-month period. We call that a prepaid expense. Oops, I went back one, sorry. Trying to get my mouse to move around. We call that a prepaid expense, okay? When we pay cash before the expense should be recognized. What if we received cash before the revenue is recognized? We call that an unearned revenue. So if I prepay my insurance or prepay my rent, I call that a prepaid expense. That's an asset account, by the way, right? It's something that I own worth value, right? If I can explain that just a little bit more, why would a prepaid expense be an asset? Well, think about insurance. If you buy an insurance policy and you pay for all of it up front, and then you only keep that insurance for a month, they owe you the remainder of the policy back. They owe you that money, and you have a legal right to collect it. And that's why prepaid expenses are assets, because it's something of value that you owned. But now let's talk about that I received cash before the revenue is to be recognized. That's an unearned revenue. What are we talking about there? It's really the same kind of thing. Think about what if you sell magazines? You sell a magazine subscription. It's a 12-month subscription, and you're going to collect $120 up front, right? You collect $120 in January for this 12-month subscription. You sell magazines. Do you have $120 worth of revenue in January? And the answer is no, because you haven't earned it yet. You don't earn it until you give the customer each magazine every month for 12 months. So how much do you earn every month? Well, you earn $10 a month times 12 months. That's what makes the $120. But until you earn it, we need to put that $120 somewhere, because it's accounting. We have to do something with it. I got the $120 in cash. Where do I post it? I can't post it to sales, right? Because I haven't earned it yet. So it becomes an unearned revenue. Interestingly enough, that unearned revenue account is a liability account. Oh gosh, wait a minute. A liability? What's a liability? A liability is something that I owe to someone. Why in the world would I consider this a liability? Well, because you owe somebody a magazine. You owe somebody something that has value of $10 every month, and that makes it a liability until you deliver that magazine. And if you don't deliver that magazine, you owe them the money back. That's what makes it a liability. Okay, probably spent enough time on that one, probably too much actually. Let's roll down to this one. Again, let's take out the parentheses first and read it without the parentheses. I paid cash after the expense was recognized. Okay, I call that an accrued expense. Very simply, folks, that's like an accounts payable. Simply a liability, right? I mean, just think about it. I got a bill. I'm not ready to pay it yet. I'm going to pay it later. That's paying cash after the expense is recognized. I have to put the bill in my accounting records now because I owe somebody something, but I'm going to pay the cash later. That's an accrued expense. Okay, let's look at the parentheses. It says that I received cash after the revenue is recognized. Well, that's accounts receivable, right? My customer owes me money. I've earned it. I've given them a bill, right? They owe me the money. That's an accounts receivable, but we term that an accrued revenue. And of course, you already know that that's an asset account. Accounts receivable, anytime somebody owes you money and you have a legal right to collect it, it's an asset account. It's something that you own worth value. Here we'll talk, we'll show you a little bit about what prepaid expenses do. This is that prepaid rent, prepaid insurance, supplies are also considered a prepaid. Resources paid for prior to receiving the actual benefit. So what happens? So here's kind of a quick example of the journal entry that would occur once we actually pay it out and then have to move it away. So the first thing that happens is that when I actually buy this prepaid asset, I'm going to put it as a debit in an asset account and I'm going to pay out cash. They don't show us that piece here. So when I go purchase that insurance policy for $2,400, the journal entry is going to be a debit to my prepaid account, that's an asset, and a credit to cash because cash is on the decrease, right? But how do I ever recognize that $100 a month? How do I ever get it out of the asset account and over to an expense account? Well, that's what's visualized right here. How I do that is that I debit the expense, and that makes sense because expenses increase by debits because expenses reduce equity, right? I know that that's probably still hard. So the expense account itself gets increased by $100, and the credit account, or the credit side, is going to be that asset, thereby decreasing that asset. Hopefully they're going to give us, they're going to show us a full example. Here it is. So December 1, fast forward, same example, pays $2,400 to cover insurance for 24 months that began on December 1 of 2015. Scott recorded the expenditure as a prepaid insurance on December 1. Prepaid anything is an asset account. So what happens? This account is going to get a debit. Likewise, the cash account gets a credit for $2,400. Remember, the accounting equation has to stay in balance, right? So you have a plus and minus in the asset side. So I have to record this $2,400 because the cash left the building, right? So I record $2,400 as a debit to my asset account. But now I'm at the end of December or the end of January, the end of February. It's going to be the same every month for 12 months. I need to allocate 1/24th of this out every month. I've got to get that prepaid insurance account down to zero at the end of the next 24 months. Everybody with me there? Hopefully you've got that. I've got to get this prepaid insurance account down to zero as I use it up because I'm going to use up $100 a month. Well, how am I going to reduce this ever? I'm going to reduce it with credits, right? I'm going to obviously have 24 $100 credits, basically $100 every month. Well, if I have a credit here and I make this in a journal entry, right? What has to be equals always? Debits must always equal credits. So if I've got credits here, I've got to have debits somewhere. Well, the use of something is called an expense, right? I'm using up a resource, so I'm going to book it as an expense. Here we go. The insurance expense account is going to be debited $100 to recognize the amount of insurance coverage for December. Therefore, the prepaid insurance account is going to be credited by $100. And here's what that entry is going to look like. So after we do the journal entry, we post it to the ledger, right? This is what's going to happen. I'm going to debit insurance expense. I'm going to credit prepaid insurance. And now the prepaid insurance account has $2,300 in it. And does that make sense? Yeah, because I got 23 months to go, right? And every month, that same thing is going to end up happening. We're going to have a debit every month insurance expense for $100. We're going to have a credit to prepaid insurance every month for $100 until we get to the end of 24 months. And really, in reality, what's going to happen? I'm probably going to renew the policy, put another $2,400 in prepaid insurance, and do it all over again. And it's just going to be this continuous cycle. Okay, it takes forever for it likes to do transitions. All right, so again, that prepaid insurance account, that's a balance sheet account because it's an asset. Got $2,300 because 23 months remaining. And then, of course, insurance expenses on the income statement. And it's an expense. It's an operating expense. That's why it goes on the income statement. All right. So how did I get it there? How did I get it to those accounts? We did a journal entry, right? I think we understand that. Here are those two accounts again. What happens every month? So in that first month of December, I posted a debit to insurance expense and a credit to prepaid insurance. And I'm going to do it every month. All right, another type of adjusting entry that we need to think about at the end of every month is this thing called depreciation. That's kind of a fun one. You've probably heard it before, but you didn't know exactly what it was. I get people posting stuff to depreciation all the time because they have no clue what depreciation really is, and um, it's kind of interesting because they'll actually post cash transactions to depreciation. They went and bought something and they record it to depreciation, and maybe they think they're mean because I get a little cynical because I'm like, my goodness, I've never once gone to Walmart and bought depreciation. I just can't find it on the shelf anywhere. And why would you buy it, to begin with? So let's see what the publisher says about it. It says instead of expensing the cost of a plant asset, okay, well, we need to explain that. A plant asset is an asset that has value, but it's very tangible, and it's usually big things, right? Like equipment, building, cars. It could be land. Plant assets typically aren't land. That's just considered land separately. Desks, computers, chairs, things that are going to last a long time that have value. So instead of expensing the entire cost of these big things in the year purchased, we allocate it over its expected useful life. What in the world are we talking about? Think about a building, right? You go and you pay $600,000 for a commercial building. Do you think you just get to expense that $600,000 in the year you buy it and write it off your taxes? The answer is absolutely not. And think about that expense or matching principle that we have. It kind of seems to violate generally accepted accounting principles if we were to write that $600,000 off in the month that we buy a $600,000 building, because that building really is something that we have to benefit making money, right? Remember the matching principle? It really needs to be kind of used up over a long period of time. Well, commercial building, probably got a 20, 30, 40, 50-year life, right? So, and let's just say it had a 40-year life. So instead of expensing $600,000 immediately, we need to expense 1/40th, right? Because we have 40 years ahead of us, 1/40th of $600,000 every year. How do we do that? We put the building in an asset account, the whole $600,000 in an asset account because it's something that we own that has a value. And then we're going to take 1/40th of the value of that building off of the assets every year and make it an expense. And we call that expense depreciation. Okay, I know that was a lot for this one kind of blank slide. Let's see how it works. First off, how do we figure out that piece? Well, I just told you 1/40th, right? How do we figure out what we call straight line depreciation? And that's what we just talked about. We take that asset cost, that would be my 600,000. We'll talk about salvage value in a second, and we divide it by its useful life. My building was 40, right? So we'd take 600,000 divided by 40, and that would give us our annual depreciation for that building. That's why I say we take it at 1/40th. 600,000 times 1/40 would be the same thing. So that useful life, again, is the period of time that an asset is expected to help produce revenues. I need that building to have clients to come to so that they can buy stuff from me. That's really what we're thinking about there. It expires as a result of wear and tear or because it no longer satisfies the needs of the business. I mean, think about a car. A car is certainly going to depreciate in value. It's going to lessen in value because of wear and tear. And then let's talk about that salvage value piece in the formula. If you just think about it for a second, I don't want to advance the slide yet, But think about that building for a minute. So if we're going to write that $600,000 building off over 40 years, and every year we're going to take 1/40th of 600,000 as an expense. Remember I told you it comes off the asset account, right? What's going to be the value of it on my balance sheet or as an asset at the end of 40 years? And if you're thinking, gosh, it'll probably be zero. But is that really true? I mean, if there's still a building standing there and there's still people able to work in it, it's still a functioning structure at the end of 40 years. Does it really have a zero value? And the answer is probably not. It certainly is probably still worth something. And that's what salvage value is. I'm going to tell you just right now, full disclosure, I don't want to hide anything here. It's a guess. Salvage value is a guess. It needs to be a reasonable guess or maybe an educated guess, whatever you want to call it. But it's still a guess. It's an arbitrary value that we assign to it. And we need it because we have this whole historical cost thing in accounting. That's what's going on. So we have to kind of make a guess at what we think it should be worth to us on our books. I think salvage value is obviously better explained with something like a car or a piece of equipment because it's simple. You know, I go buy a car for $25,000 and I think it's going to last me for 5 years, right? Well, if I write off $5,000 every year, it's going to say that it's worth zero on my books at the end of 5 years. But the truth of the matter is, I can probably still sell it for $1,500, $2,000. Even if I took it to the scrapyard, I'm going to get some money for it. And that's what salvage value is. It's the expected market value or selling price of an asset at the end of its useful life. So it's also called scrap value or residual value. Okay, so here's a depreciation example that we're going to run. Fast forward again, purchased equipment on December 1 for $26,000. It has an estimated useful life of 60 months, 5 years, 60 months. Just depends on how often you want to do depreciation. Can you do it annually? Sure. Can you do it monthly? Sure. Just depends on how you're running your accounting periods, what cycle of time you're using. The equipment is expected to be worth about $8,000 at the end of 5 years. Well, that's salvage value, right? If we're thinking it's going to still be worth $8,000 at the end of 5 years, that would be the salvage value. We purchased it on December 1, but it is currently December 31. How are we going to deal with this? Because we expect it to be worth $8,000 when the 5 years are over, only $18,000 of the cost has to be spread over 60 months. Where did $18,000 come from? Well, that's the $26,000 up here minus that $8,000 is going to give you $18,000. So if we're going to put it in the formula, this is what it looks like, right? We're going to take $26,000 minus the $8,000 for our net cost of $18,000, and then we're going to go ahead and divide that by 60 months. So it's the original value minus the salvage value. That's $26,000 minus $8,000 to give us this $18,000 divided by 60 months, which means our depreciation is going to be $300 per month. Okay, that's how we calculate it. I know that seems like a lot to get around to it, but really it's not that hard, right, when you think about it. If I had a $25,000 car that had a let's say a $5,000 salvage value, I'm going to take $20,000 divided by 5 years. I'm going to have $4,000 a year in depreciation. Pretty simple. So how do we end up dealing with all this stuff? Well, when I purchased it, my journal entry was a $26,000 debit to equipment and a $26,000 credit to cash. That was the original purchase. We're not really worried about booking that because we're talking about depreciation. So what's going to happen? Well, in the accounting equation, if we were to analyze it, I think what has to happen is that depreciation expense is going to get that depreciation cost that we just calculated of $300 because I'm using up a part of that $18,000 of value. But where am I going to put the credit side? And initially, you might have thought from the prior prepaid stuff that we looked at that we would take the $300 and credit it off to equipment to leave, whatever value is left in that equipment account. But rather than do that, we've got this special account that we use. We really always want to leave this on our books until we get rid of it. Reason is because this is arbitrary. This $300 is basically a guess that we're making. right? We think the equipment is going to last for 60 months. We think it's going to be worth $8,000 at the end of that 60 months. So we think $300 a month is an appropriate write-off for this piece of equipment. It's a guess. We want the readers of our financial statements to see what we originally paid for it all the time. And we also want them to see our guess. We want them to see what we think we've been writing off as appropriate. So we've created this whole new account called accumulated depreciation, which is going to be listed on the balance sheet right under equipment as a negative, right? Because it's a credit. And it's going to show the net value of the equipment. We'll see it here in a second. We have a special name for this type of account. It's called a contra account. Do you know what contra means? It means the opposite. It means do the reverse. It means do the different thing, right? Contra is what we're talking about. Accumulated depreciation is an asset account, but it's a contra asset account. Why? Because asset accounts have a normal debit balance. Our contra asset account would have a normal credit balance. Okay, that's basically the rule there, and we'll talk a little bit more about that later. Let's look at the journal entry for booking that depreciation. Simply enough, I kind of like to do this part down here before this part, but you know the publisher likes to do it separate, so we'll go with what he says. But we do the journal entry, and we've got depreciation expense for 300, our accumulated depreciation equipment of 300. You can see how it affected those two accounts. But here's what we want to show you. This is as of February 28th. Don't say, oh gosh, what happened to the 300? We're fast forwarding about 3 months. So we've already booked depreciation for December of 300, January of 300, and February of 300. See the time, right? Obviously, 300 times 3 is going to be 900. But this is really what we want to show you about how that contra asset account is going to be listed on the balance sheet. We're always going to show the asset itself at the original historical cost. There's our equipment for $26,000, less our contra asset account of accumulated depreciation. So we're going to physically show that that adjustment of $900 in our asset section to show the write-off of that value, which tells us that we believe our equipment now has a value of $25,100 on our balance sheet. Okay. Yes, I already told them that. I'm ahead of the publisher, right? All right, another type of adjustment. We talked a little bit about unearned revenues. Again, unearned revenues is when we receive cash in advance of providing the product or service. That's my magazine subscription example, right? Somebody buys a magazine subscription from us for $120 in January, and it's a 12-month subscription. That's really $10 a month. But because I received the cash, what happens when I receive cash? I have to record it, right? And the journal entry to receive that cash was a debit to cash of 120 and a credit to something of 120. Well, what's it got to be a credit to? That's this new account, this new liability account called unearned revenue, right? Because we haven't earned it yet. I haven't delivered the first magazine yet, so it goes in unearned revenue. But as every month goes by and I deliver one more magazine, 10 months has to come out of that unearned revenue, can't say it today, out of that unearned revenue account and go over to our revenue account, okay? So unearned revenue, again, is a liability. We know that revenue is an equity type account. Because it's an equity, equities are on the right of the equation and credits are on the right of the equation. Credits increase equity accounts. You see that, okay? All right. Accrued expenses. Same thing, but in a different order, right? Those are costs incurred in a period that are unpaid and unrecorded, right? So maybe the telephone bill. I haven't booked that telephone bill in yet, but I'm not going to pay it until a later time. I need to go ahead and increase the expense, right? That'd be telephone expense, but I'm not going to pay it till later. I owe somebody something. So the same type of thing there. Accrued revenue, that's the accounts receivable. My customers owe me money, right? What happens with accrued revenues? Accounts receivable gets debited. We already know how to do this. And the revenue gets credited until I get paid. It's just another way to talk about it. This one just kind of links it to the financial statement. What happens? So prepaid expenses, if we don't do the adjustment entry, If we don't book the adjustment entry, your assets are going to be overstated, your equity is going to be overstated, but your expenses are going to be understated. That's actually going to create an overstatement of net income. You'd have to pay more taxes on that. That sucks. We don't like that. And this over here just shows you the type of adjusting entry that needs to happen for each one of these types of adjusting entries. So it's just a graphical representation of each one of those. All right, after we do all of our adjustments, we get into another proofing statement. So here's kind of the cycle so far, right? We've already done the first 4 steps. We've got all the way through to where we create our first trial balance. That's our first proofing statement from doing our regular transactions. And then we go into this adjusting process and we do all these adjusting journal entries for prepaid expenses, for unearned revenues, for accrued revenues and accrued expenses. We make all these adjustments. Well, that means that we've been doing more journal entries, we've been posting to the ledger again, and anytime you do that, you must follow it up with another trial balance. But what we're going to do now is we're going to call this the adjusted trial balance because we're taking our original trial balance, the one that we did before. Now we're going to post debits and credits as adjustments to the accounts that are necessary. And then we're just going to come across and create our new adjusted trial balance. But look at what's happening here, right? There's nothing that changed in the cash account, so it still has a debit balance of $42.75. Accounts receivable started with 0, but now we've adjusted it by $1,800 debit, so now it has an $1,800 debit balance. Look at supplies. It originally had a $9,720 debit balance, but we've taken $1,050 out of that account for some reason. It now has an $8,670 balance. Let's talk about why it has that $1,050 credit. Probably because we used up some supplies. Would that have been an adjusting entry? Yeah. Remember what I said? You buy supplies and you stick them in a closet, and eventually those supplies are going to get used. Well, how do you ever figure that out? You go take a supply inventory at the end of the month. That's what you do, right? So you go and you count the supplies in your closet and you realize it's not worth $9,720 anymore. It's worth $8,670. So I need to credit the account $1,050. Well, what happens if I credit that account $1,050? It means I had to debit something $1,050. Well, what could that possibly be? Even if you didn't know, if you start scanning down a little bit, you can see that we debited $1,050 to the supplies expense account. That's a journal entry, and it even has the same reference number, right? Matter of fact, all of these have corresponding debits and credits. You see, they're all journal entries. Don't debits always have to equal credits? There's the 250 and the 250, okay? The 1800 and the 1800, see those? Okay, debits have to equal credits. These are just journal entries, and now we're just putting it into a worksheet so that we can visualize the change from our original trial balance to what is now our adjusted trial balance. From the adjusted trial balance, and here's the thing you didn't know until now, from the adjusted trial balance, that's where you're supposed to create financial statements. You always create your financial statements from your adjusted trial balance, because until you adjust the books, you shouldn't create the reports, right? Because the reports won't be true until after that. You've already seen this. You saw this in Chapter 1 and Chapter 2. We're going to say it again. You must do the financial statements in a particular order in order to be correct, because every statement works off the other. You always start with your income statement. What's that? That's our revenues and expenses to result in net income or net loss. After we do the income statement, we create the statement of retained earnings. What's that? It explains our change in income and dividends, right? So basically it shows how our equity account is either going to increase or decrease because of income and dividends. Then we prepare a balance sheet which explains the accounting equation. It shows our assets first, then it shows our liabilities, then it shows our equity. It adds liabilities and equities together, and it's supposed to equal our total assets because that's the accounting equation of assets equals liabilities plus equity. Then we prepare the statement of cash flows, Chapter 12 is all about cash flows, but all it does is talk about the changes in our cash inflows and outflows. We're just going to go ahead and walk this through. Here is our adjusted trial balance for Magic Company. I really wish they had stuck with fast forward because we already saw some of that, but you know how publishers go. So this is Magic Company's adjusted trial balance. Look, trial balance is still in order. We always report assets first, then we report liability type accounts. Remember, anything that has the words payable or unearned is a liability type account. Then we report our equity accounts, that's common stock, retained earnings, and dividends, right? Then we report our revenue accounts. We only have one here. Anything that says earned revenues, sales, anything, fees, anything like that's going to be a revenue account. Then we record our expense accounts. That's our adjusted trial balance. Okay. From this adjusted trial balance, we create our income statement. Well, the income statement is just revenues minus expenses. Do we know where they are? Yes, they're always at the bottom of the trial balance. There it is, $79,000. Our two expenses, $56,000 and $8,000 total expenses. We have a net income of $15,000. You've not seen this number anywhere in our books until you create this statement. So the creation of the income statement is what gives us the word, the title, and the result for net income of $15,000. Next, we do the statement of retained earnings. Okay, so we still have our trial balance. Now we have an income statement. There's our net income. Okay, so what we are always going to start with is what was your retained earnings at the beginning of this period. So these statements are for the entire year ended December 31, 2015. So we must start with retained earnings at the end of 2014, which is the same as January 1, 2015, right? Do we know that number? Yes, we do, and you're not going to understand it yet because this says December 31, 2015. Why is this still the December 31, 2014 number? See that? Because this number never, ever, ever, ever changes until after all the financial statements are completed. You'll see that in just a little bit. We're going to explain that to you. But the retained earnings number never changes until after your financial statements are complete. So at this moment in time, the retained earnings number on our adjusted trial balance is the same right now as it was at the end of last year. So we start our statement of retained earnings at December 31, 2014 with $45,000. And then how is retained earnings supposed to change? Well, it changes by all your revenue, all your expenses, and your dividends. Okay? Well, we already know what revenue minus expenses is, don't we? Because we just did it in the income statement. We calculated that number. We called it net income. So we're not going to put revenues and expenses again here. That would be dumb. We're just going to say, hey, we had net income. Let's add in the $15,000. If it were net loss, we would take away whatever that number is, right? Then we must also take away our dividends. Here's our dividends. It's a debit, $20,000, right? Minus 20,000. We take 45 plus 15 minus 20, and it says that once we make this change to retained earnings at December 31, 2015 will be 40,000. It's not yet. It's still there. We haven't incorporated. I mean, that's really what we're going to do. We're going to incorporate all of this into this number later. We haven't done it yet, but once we do, it's going to be $40,000. Okay? That's all the statement of retained earnings really does. After we do that, we have to do the balance sheet. Again, here's our trial balance. We already did the income statement. We already did our retained earnings statement or statement of owner's equity, whatever you want to call it. It's all the same thing. Okay, now we're going to do the balance sheet. The balance sheet always reports your total assets, then it reports your liabilities, then it reports your equity, and then adds the two together. Okay, well, do we know where assets are? Sure. It's always at the top of the trial balance. There they are. Cash, accounts receivable, land. We bring them in. We have total assets of 115. You don't see that number anywhere in the trial balance. It has to be calculated here on the balance sheet. There's total assets. Okay. Next, you record liabilities. Do we know where they are? Yeah, it's everything that says payable or unearned or deferred, right? There it is. Accounts payable, long-term notes payable. I bring them down here. I add them up, and I've got 45,000. Next, I do my equities. Well, where's the equities? First equity account is common stock. And then you might want to report retained earnings at 45,000, but wait, Remember that retained earnings is supposed to change by all this stuff, and we created that number here on the statement of owner's equity or statement of retained earnings. So we're just going to bring that, just like we did the income here, we're going to bring the retained earnings down here. In essence, folks, and you just got to follow me here, and if you don't get it today, just trust me, this 40,000 is basically the result of all of this, right? This 40,000 represents from here down, every account from here down, right? Think about it. 45,000 minus 20,000 plus 79,000 minus 56 minus 8. It's this 40,000, right? You can do that math all day long, but it's really how we get all of that to this balance sheet. I told you they all interrelate, no question. We add the 30 and the 40, we get 70,000 for equity, and then we add liabilities and equity. We're going to add the 45 to the 70, it comes up to 115,000. Is it a coincidence? Absolutely not. They're supposed to equal, right? They're supposed to equal. That's what makes this a balance sheet, and it's what makes our accounting reliable because it's self-proving. It is a self-proving information system. Our first proof was right here that debits equal credits, right? Remember that the debit column and the credit column must be equal, right? So that's our first proof. And this is our next proof, because even though we kind of massage and manipulate all this information to make it readable, it still proves itself out, okay? And that's what makes the information reliable. All right, so now we've got to go one more step. We've done the adjusted trial balance, we've created the financial statements, and I'm going to go back a slide real quick. Remember how I said, somehow all of these things have to get into retained earnings. At some point in time, all of these numbers are going to be rolled up into retained earnings, and retained earnings is going to equal 40,000. Well, that's what comes next. Remember how I said it's going to stay the exact same thing until we complete the financial statements? Well, the financial statements are done. So how do we get all that stuff up into retained earnings? And that's the process of preparing closing entries. That's what's going to happen next. So in closing entries, basically, we're going to close, or we're going to zero out. That's what we mean. We're going to zero out all of our revenue accounts. We're going to zero out all of our expense accounts. We're going to zero out our dividend accounts, and we're going to push it all into retained earnings. Well, that kind of makes sense because that's exactly what the retained earnings statement showed us. We brought all of the revenue accounts and expense accounts into retained earnings, and then we brought the dividends into retained earnings, and we had a new retained earnings number. So that's what we're doing. This third step in here is the weird one. So what happens, and it's a new thing, we didn't do this when I was taking accounting, I promise you, and old school accountants like me, we still skip this step, right? Because when I was in school, we closed revenue accounts to retained earnings. We closed expense accounts directly to retained earnings, and we closed dividends into retained earnings. The publisher and new accounting, it's the new math, right? They want you to take one extra step. They want you to put the revenue accounts into income summary, expense accounts into income summary, and then move income summary into retained earnings. Well, that's the same thing. You're just putting revenue and expenses into a temporary account before you put that temporary account into retained earnings. It's weird. I think it's just as easy to close it the other way, but we have to kind of follow what they're telling us to do, right? So let's see if we can go ahead and do that, prepare that closing entries and post-closing trial balance. So it says list of permanent accounts and their balances after post-closing entries and total debits and credits. And what they're not even going to show us how to do the entries. But so if we're going to list those things out, what are permanent accounts? Well, if you have permanent accounts, it means you must have temporary accounts. Quite simply, your permanent accounts are your asset, your liability, and your equity accounts, right? Those are the things that stay on the balance sheet. The accounts that remain on the balance sheet are permanent because they don't change, right? You're not going to zero out cash at the end of the year. Whatever cash you have is you're still going to keep. You're not going to zero it out. But you are going to zero out all of your income statement accounts, right? You're going to zero out your revenue account at December 31. You're going to zero out your expense accounts at December 31. And you might say, well, why would I do that? because you're looking at your accounting in a cycle for 1 year. You say, how much money did you make last year? Oh, I made $100,000. Well, if you get to January 2nd and you still have money in your revenue and expense accounts and you say, okay, well, how much money did you make this year on January 2nd? That 100,000 needs to be off the books, right? It needs to reset to zero before you can start a whole new year over. So we call income statement accounts, that's our revenue and expenses, we call those temporary accounts. Those are the ones that we're closing into retained earnings. Dividends is also a temporary account. We close that into retained earnings as well. So once we finish, and gosh, why do they do this? Because now this is a post-closing trial balance for Fast Forward, not Magic Company. Because what you would have seen is that Magic Company's post-closing retained earnings would have been that 40,000 number. What you don't see here in this post-closing trial balance is you see no revenue and no expense accounts at all. Okay, so that's really the process. Let's just talk real quick about identifying the steps in the accounting cycle. I'll tell you what, I'm going to make sure that when we do the group work that I show you that post-closing piece, that you'll see how those accounts are closing out. Here's the full accounting cycle. Now you've actually seen the whole thing, right? You thought at the end of chapter 2 you were done. Obviously you weren't. So the first part of it was that we analyzed and identified relevant transactions. We really don't do anything there except look at stuff, make sure that it's okay. We take those relevant transactions and we create journal entries, and we create our general journal. When we create that general journal, we post those transactions to our general ledger, and from there we create our first proof report, our unadjusted trial balance. Then when we hit the end of the accounting cycle, we create adjusting entries with more journal entries, and we post those journal entries then to our general ledger as adjustments, and from there we create another trial balance, but now we call it an adjusted trial balance. Once we have that adjusted trial balance, we prepare our financial statements. After we complete our financial statements, we're going to create our closing journal entries by closing out our temporary accounts. Basically, we're going to zero out our revenue and expense accounts to income summary. Then we're going to zero out income summary to retained earnings. Then we're going to zero out dividends to retained earnings. And once we do that, we're going to create one more trial balance because we still have to prove that it's reliable. Debits must still equal credits. We're going to do our post-closing trial balance as our final proof. What we haven't talked about, and we're really not going to talk about, is number 10. We're going to talk about why 10 is necessary later as we start talking about end of period adjustments, but we're really not going to explain it in this chapter. And then guess what? It starts all over again. That's why it's a cycle, right? A cycle never ends. It just keeps going around in this crazy circle. And this, folks, is my world. This is what accountants do all the time. Thankfully, the computer does the majority of this, right? We just have to get the information in the system. All right, got to talk real quick about classifying the balance sheet accounts. A classified balance sheet. At this point, you've only seen that the balance sheet is assets, liabilities, and equities as a whole. But we can change that to have a little bit more meaning. So we can call our assets current and non-current, and we can call our liabilities current and non-current. This is really a pretty simple concept. Basically, anything that is current are things that are expected to happen within a year, right? In 1 year. So basically within a year. If it's non-current, we also call non-current things long-term, then basically it's going to happen a year or after. It's that simple, right? So in assets, we have assets that we say are viable or usable to us within a year or less. Those are our current assets, 1 year or less. That's things like our cash, right? That's immediately available. Accounts receivable. I don't want people owing me money for more than a year for sure. So accounts receivable should be a current asset, right? What about non-current, the long-term ones? Well, that's things like our buildings, right? It's stuff that has value that's going to last us more than a year. Equipment, buildings, cars, computers, stuff like that. Trademarks, patents are intangible assets. What about on the liability side? Current liabilities are things that we owe within 1 year or less. That's our telephone bill, our electric bill, stuff like that. That's why accounts payable is a current liability. Non-current liabilities are debts that we owe past 1 year, like a mortgage or on a building, right? We owe the bank something past 1 year. That would be non-current or a long-term liability. And then there's equity. Equity really is not split up into current or long-term or current and non-current. Okay, current assets, again, expected to be sold, collected, or used within a year. Long-term is anything more than the 1 year operating cycle. Plant assets are tangible, long-lived assets like buildings. We just talked about those. Intangible assets, things that you cannot touch. Things like patents and copyrights. Those last usually for more than 1 year, but they're intangible. You can't really touch them, but they have value to you. When you buy a trademark, that has value, right? Current liabilities, again, those things that we owe within 1 year or less. Long-term liabilities are things that are due within the longer of 1 year or more. Equity, we know, is our claim on assets really has no long-term or short-term piece. And that, folks, is going to be the end of chapter 3.